This is a sincere caveat. If you have invested in China, pull back your money. With the Chinese Communist Party, anything can happen. Beijing could start imposing curbs and killing the enterprise you have invested in, or a hardline communist leader could simply hark China back to the Maoist era, or worse still, a defaulting firm could prioritize domestic investors and throw you under the bus. Foreign investors in the China Evergrande group have actually been thrown under the bus. The Chinese real estate giant has been on the brink of defaulting for quite some time now. It was unclear how the Evergrande debt default would pan out. But now things are becoming clear. Foreign investors can say bye-bye to their millions because Evergrande is in no mood to pay them back. Hi and welcome to TFI Global, the foreign affairs and geopolitical analysis arm of the TFI Media Group. I am your host SHUBHANGI, and in this video I will explain how Evergrande has sent a beautiful message to the world. Don't invest in China. China lovers are in for a shock, and foreign investors who had parked their money in the China Evergrande group are in for an even bigger shock. The real estate giant, which is at the brink of making a default on debt repayments, has made a shocking announcement. It will prioritize interest payments on domestically issued bonds only. This has raised suspicions amongst foreign investors that they will be the last ones to be repaid. Hengda, Evergrande's primary unit in mainland China, has announced that it will pay coupons worth $19 million on its October 2025 bond that becomes due on Tuesday. The announcement came as a shock for foreign investors as the real estate giant has failed to meet 3 rounds of bond interest payments in the offshore market worth $277 million since late last month. So it is quite clear that offshore investors are coming last in the line of repayment. Given China Evergrande Group's cash crunch and tight liquidity, it seems quite likely that the real estate giant would be able to meet only domestic bond interest payments, and offshore bond interest payments might not even take place. Nikkei Asia has quoted a portfolio manager as saying, "Earlier this year, fearing a situation similar to what we are seeing now, we began selling out our dollar bond exposure to Evergrande." He added, "Our assumption has been vindicated. Offshore creditors have the least protection in the event of liquidation of Evergrande, and we assume bondholders will recover about 10% of their total dues only." China Evergrande Group has a total $20 billion in outstanding offshore bonds, so we are talking about sizable foreign investment becoming a victim of China's unfair and unequal economic practices. Alicia Garcia Herrero, chief economist for the Asia Pacific at Natixis, said, "All in all, Evergrande has many stakeholders and creditors, but not all are equal. Offshore bondholders seem to be the last in the queue." The problem with investments in China are hardly limited to the China Evergrande Group alone. The entire Chinese real estate sector is in trouble. The real estate bubble in China is simply too fragile and almost about to pop. China Evergrande Group's downfall is being described as China's Lehman moment, and real estate groups like Fantasia Holdings have already shown signs of falling in a debt crisis. Going ahead, a number of Chinese real estate giants that had relied on heavy borrowing through both onshore and offshore debt instruments to finance construction of useless infrastructure are facing a difficult situation. And on top of all this, the China Evergrande Group's prioritization of onshore bond interest payments have created a strange precedent. From now on, all defaulting real estate giants might start prioritizing onshore bond interest payments to avoid local flak and leave the foreign investors to fend for themselves. Evergrande's decision is a big lesson for foreign investors. If you invest in China, do so at your own risk because there is no security of return and Beijing will start looting you at will. Yet there are many investors and portfolio managers still parking their money in China. Ray Dalio, founder of the $140 billion hedge fund Bridgewater Associates and a prominent American investor, said that he spoke to the Chinese Communist Party officials and was encouraged by what he heard. Dalio said, "At this stage, I'm assured that this does not mean foreigners and foreign investors are not welcome." The 72-year-old added, "We are in an environment that is unsettling to investors, but China's motivations should not be interpreted as a return to Maoism." Howard Marks, co-founder of distressed asset manager OAKTREE Capital Management too, said, "Compared with the US, Europe, and Japan, I think of China as an economic adolescent, tempestuous and volatile, but its best decades are ahead. Clearly, there are investors and fund managers who still argue that the ongoing disruption in Chinese markets is merely temporary. Yet you can't compare Chinese markets with those in Europe or the US. The problem with China is that it is more political than economic. The CCP is basically dishonest and therefore it does not try to uphold the interests of foreign investors. There is only one way that foreign investors can save themselves from China, that is, by not investing in China.